Hi, my name is Patrick Ritchie, and today we're going to do a case study about a library collection. How in the world is it that a library collection could cost somebody $10,668? Well, it sounds ridiculous, but it's absolutely true. It was a situation in one of my transactions, and this case study hopefully will hit home on the importance of not allowing circumstances to change. One of the things I always tell clients and I always tell students is to watch out for things that aren't on your credit report yet, because those are the things that will come back to bite you later on when you least expect it and at the worst possible time. So this is a real story about an unexpected consequence. An engaged couple had come to me. They needed pre-qualified and pre-approved for buying a new home from a builder. And so they were very excited. They had planned a wedding and they're starting their new life together. Everything was very happy. Everything was very exciting. And here they were going to get their dream home. So it was going to be 6 months before the home was finished. So what we talked about is between now and 6 months, we need to make sure that nothing changes. Don't quit your job. Don't get fired. Don't co-sign. Don't get new debt. Don't let things go to collection. All that stuff that we would normally talk to people about in terms of the mortgage process, a real estate transaction time frame. So the mortgage is approved, but we still have a lot of time before the home is going to be finished. So obviously things are going to have to be updated. And basically I just tell them, live in a bubble. Don't do anything that's going to change between now and then. So fast forward to the 5th month. Credit reports are only good for so long. Generally, beyond 90 days, a new credit report is going to need to be pulled. Now, you don't want to be constantly pulling new credit reports. So generally speaking, when we're within 30 days of closing, we're going to pull a new credit report to make sure that nothing has changed and to make sure that the FICO score has not dropped. Hopefully it's gone up or at least stayed the same. But in this case, I pulled the credit report and there was a surprise. The library called and they want their fine paid. But unfortunately, they did not actually call. They sent the fine to a collection agency, and as a result, the collection agency sent the collection to the credit bureaus. So all 3 credit bureaus, TransUnion, Equifax, and Experian, were now reporting this collection on her credit report. So what was the result? Well, she had a 729, and now she's dropped down to a 661. You always have to go with the lowest of the 2 FICO scores when you have multiple borrowers. So he had a really high credit score. He was like, 740, 750. She had a 729, which was still a good credit score, but we had to go with hers based on hers being the lower of the 2 scores. And that's what the interest rate is going to be based on. And in their case, they were putting 5% down. So they had to have mortgage insurance, private mortgage insurance. You'll hear it called PMI. PMI is something that you're going to have anytime you're putting less than 20% down. So now, because of this collection that was generated by her not paying a fine, she's dropped from 729 to 661. It starts to change some things. So how did this happen? Well, first of all, very rarely do we read the policies, terms and conditions, all of the small print, the stuff that you need a magnifying glass to actually read. But the next time you go to the library or the next time you're on your library's website, check out what their policy is in regards to fines. For this particular library that is in question, their policy was that if you accumulate a fine of $30 or more, if you don't pay that within 30 days, they will then send you to collections. And then once they do that, they're going to add on, the collection agency is going to add on a $40 fee. So whatever you owed, now they're going to tack another $40 on that for the collection fee. And that's going to go on your credit report. So that's what happened. She had a bunch of books and she forgot to return them. By the time she realized, hey, I have these books, I need to return them, she had accumulated quite a fine. So she returned the books and thought everything was okay. sort of forgot about the fine because it's kind of like, okay, it's a library fine. I'll pay it the next time I come in. Well, she didn't go in for a while. And because she had gone over that $30 threshold, the clock started to tick. She had 30 days to pay that before they would send it to the collection agency. And unfortunately, that's what happened. So her impact on the FICO score with that collection, it hits two key points in terms of what is going to increase her costs. First of all, the interest rate is going to go up a little bit. And she's going to have a higher premium on her mortgage insurance because the better the FICO score, the lower your mortgage insurance would be on a conventional loan. That's for the private mortgage insurance, not to be confused with FHA's mortgage insurance, which is going to be the same for everybody no matter what your FICO score is. But of course, the interest rate is always going to be impacted by the FICO score. So now at a 661, she's a far cry from where she was before at the 729. So in her case, the rate got an eighth worse. So 0.125 worse over 30 years. That's going to cost her $5,367.60. As far as the private mortgage insurance, it's a factor that you multiply, you take the factor and you multiply it against the loan amount and you come up with an annual amount. You divide that by 12 and then you get your monthly mortgage insurance. Well, in her case, at a 729, she was at a factor of 0.62. After her scores dropped to 661, now the factor jumped up to 1.15. In her case, this was a $200,000 loan amount. In her case, it increased her monthly mortgage insurance by $88.34. So she's paying that additional to what she was already going to be paying. So it almost doubled from what she was going to be paying before. So that's how important keeping that FICO score as high as possible really is, because it can come back and really cost somebody. $88.34 more per month. Let's assume, because the private mortgage insurance is not forever. On FHA, as of summer of 2013, I believe it was June 2nd, 2013, FHA mortgage insurance is for the life of the loan currently. But for private mortgage insurance on a conventional loan, it's not forever. Once somebody pays their loan down to 78% loan to value, which means you have 22% equity, it automatically drops. Now that's based on the original value. But what if my value goes up before then? Well, you can always contact the mortgage servicer, which is the company that you're making your payments to, not necessarily the company that originated the loan, but whoever you're making your payments to right now, contact them and say, I believe that I have 20% equity. So they will give you the names of some appraisers that you could hire to come out, do an appraisal, and see if you have 20% equity. And if you do, and you've been paying on time, and you don't have a line of credit, any other loans against the house, you should be able to get rid of the mortgage insurance. So in this scenario, I'm going to assume that in 5 years, with 5% down, that maybe this couple is going to have 20% equity. It could be longer. If we just waited for it to reach it naturally just by paying each month until it hits 78%, we might be talking 8 to 10 years, right around that 10-year mark perhaps. So I'm being a little less than conservative to say 5 years, but if she does have this for 5 years, then she's paying $88.34 per month more because of the drop in her FICO score. In 5 years, that's going to cost her $5,340. So what's the solution? Now all of a sudden, her monthly payment has gone up, or I should say their monthly payment has gone up as a result of this library collection. So her first instinct was, well, I'm just going to pay it and that'll make it go away. But that's inaccurate. Paying a collection does not take it off of your credit report. So she did pay it as soon as she found out about it, which is what most people would do, but it was still there. And we were on a very short time frame to get this taken care of. There's a thing in federal banking called the Uniform Retail Credit Classification and Account Management Policy. That is about the most boring reading that you'll ever have, but I've read it a few times. And so one of the things that I generally suggest is to ask if something can be removed. It never hurts to ask. in this policy manual, there is a thing called re-aging, which gives a bank the right or the ability to voluntarily remove a late payment, something of that nature. Not necessarily going to translate directly into the collection world, but I said, based on that uniform policy manual, go to the library and you need to ask them for a huge favor. You need a huge favor. You need the library to instruct the collection agency to remove the collection from your report. You need to ask the library to instruct the collection agency to remove the collection from your 3 credit reports. If they do that, your scores should go back to exactly where they were, because now that collection is no longer on the credit report. It's not going to factor into the credit score. And so you should go back to exactly the way you were prior to that collection. So she goes to the library and she finds the person who has the ability to make that call. And she begs and she talks about what the cost is going to be. And when you think about it, for hers it was a $70 collection on her credit report. It's going to cost her literally over $10,000 over the life of this loan. It's going to be significantly expensive. So fortunately, the person was compassionate. They did make the call. They instructed the collection agency to remove the collection. Now, we were on a short time frame, so we didn't have time for this to update naturally. Typically, it would probably be within 30 to 60 days that it would update, probably 30 days. But we didn't have that because we were within 30 days of closing. So what a mortgage lender can do is what's called a rapid rescore. A rapid rescore is where they go directly to their credit report provider. They have to pay money for this, but it gets something updated on the credit report within generally less than a week. It could be as quick as 72 hours. It just depends on how busy the credit bureaus are at the time. So it can happen quicker that way. Doesn't work for every situation. That's important to know. It only works for certain situations. You have to provide a letter from the original creditor saying that they have updated the credit bureaus, that they have updated Experian, Equifax, and TransUnion. So I've had some luck with this, and I've also had it not work. Fortunately for her, it did work. Was she lucky? I think we do create our own luck. The fortunate thing for her was that everything else on her credit report was positive. The good news, even if it wasn't changed, was her credit was good enough at 729 that it was able to absorb this collection, and she still qualified. She was still able to buy the house, although it was going to be more expensive with the slight increase in the interest rate and then the huge jump in the mortgage insurance. So even though that was going to be the case, she still could buy her house. She just wasn't happy with the increase, and I wouldn't be happy with that either. So she followed directions. She followed the instructions. She followed through to see if maybe this situation could be taken care of. So she sort of created her own luck by following the instructions and doing it rather than just saying, oh, well, nothing I could do about it. Because there was something that she could potentially do, and that's to ask if they would remove it. And they did. But do you think that she'll ever be late returning a library book again? Probably not, because that's what created the situation in the first place. So sometimes it's something that happened maybe 6 months ago, a year ago. I've seen collections come back 5 years ago. I've seen collections come back, medical collections, where they hit somebody's credit report 5 years. Like it literally was connected to the birth of a child, and now the child is in kindergarten, and then a medical collection comes up. And they're usually small. These are usually amounts that are less than $100, but they have a huge impact on people's credit scores. So fortunately, it worked out for her. It doesn't always work out, so I guess she was a little bit lucky there. So join us next time. I hope you enjoyed this case study. I plan on doing this as a monthly on-demand webinar. I have a lot of cool stories to tell that really hit home on the things that we need to watch for in a real estate transaction. It doesn't have to be stressful. It can be smooth. It's just about being aware. It's about knowing the things that can happen and making sure that we avoid those. If you'd like to check out my new book, The Credit Road Trip, you can go to creditliteracyproject.com. That's my most recent book. It's geared towards the younger consumer. I wrote it from the material that I present in my guest speaking at The Ohio State University. And so it's a really good book for a young adult. So if you know a young adult who could learn more about credit, who could benefit from that, this is definitely the book for them. So go check it out. And also the credit roadmap is there. And then my book for small business owners, the credit roadmap for the self-employed. All three books are on that website. So join us next time, and best of luck to you.